Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be talking about a little bit of an interesting topic in scaling in. So this isn't necessarily going to be for traders who are trading smaller size, anything like that, but this is more along the lines of building into a position. Now, there are a couple different ways to build into a position. First of all, there is simply building into a position by, looking for a market that's doing preferably whatever you like, in this case an uptrend, and we're looking to build in let's just say as an example, we can go in with 5 contracts, but we don't want to put everything in all in one spot because we could potentially average ourselves down to get a better price. So you buy one here and you let the market go a little bit further, and it looks like it's bottoming out a little bit, so you buy another one there. You get the idea, right? And the idea is that you're amassing a position that, although you might be able to trade up to 5 contracts, you might only get 2 or 3. Now, that is averaging down. And what I mean by that is you're averaging into a position with worse and worse prices, meaning that the market is going against you when you're averaging in. It's very, very difficult to do correctly. And we'll talk about a couple of the reasons why in a second here. The other type is scaling and averaging up. And what that means is when the market is breaking away like this, you're buying some here and you're buying some there and buying some there, etc. That approach is a lot easier to do provided you have a strong enough market. And that's where, things get a little bit interesting, because the psychological aspect of things this way that we're looking at now, averaging up, psychologically is much harder to do versus averaging down. It's a lot easier mentally, I don't know why, but it's a lot easier mentally to average down than it is to average up. So here's a couple things to consider. When you're averaging down, right, meaning that the market is coming up and you're looking to buy the pullback, so you're buying in as it's doing this, right? So you're buying some here and you're buying some there, etc. The big thing to keep in mind is your risk exposure. One of the huge problems that a lot of new traders, especially new to scaling into trades, do is they go way too hard, way too fast, and they go in just with too big a size, right? They buy one here, and then they buy another one here, and here, and here, and here, and they just scale in super heavy. Now, that's okay if you have a massive account and you know what you're doing, but new traders probably don't have either of those. So this is a situation that can get out of hand really fast. And if you've tried scaling in, you've probably fallen victim to this a couple times, in that it's super easy to get out of control real fast. And now you're in a position where it does something like this, is looking good, and then this happens. Now you can no longer manage the risk because you've gone in way too big, way too fast. You need to pay attention to your average price, and you need to do as good of a job as you can to do as much in your favor of your average as humanly possible. Now, what do I mean by that? Well, instead of going in full bore like that, what I like to do when I'm averaging down into a position is go really, really slow, right? If I have 2 entries that are relatively close together, if I buy one here and then buy one there shortly after, I'm going to hold off the gas pedal for a long time. I'm not going to buy in and just keep boom, machine gunning it on the way down, because that's where the problems start. It's significantly easier when you're trading really low exposure on your account to stay mentally calm. When you're in 15, 20, 30 contracts and the market's just flying against you and you're trying to furiously add in, your emotions are taking over. You're not trading your plan, you're not trading the technical patterns, you're not doing what you're supposed to, you're trading purely on emotion. And that is drawn by the fact that you're just doing it too aggressively. So one of the better ways to do it is to look for structural clues and go slow, right? So let's say as an example, the market is, let's just look at a real life example here. Let's take a look. What one was moving? The markets were really, really slow today. But let's look at, I don't know. Let's look at Estee Lauder, since I already have that one open. So what are we looking to do on this move? Well, if we're looking to buy in a pullback and we're scaling in and averaging into a position, this market has gone absolutely haywire. Now, they did have earnings earlier this morning. You have to keep that in mind as well. There are some extrinsic factors that could potentially have some issues on the move, but just for example's sake, you're looking at this in pre-market and it's looking beautiful. You want to buy into the pullback. So what do? Well, the morning move happens, puts in a new high, and dumps really quickly down to a new low. So you buy one. And the anticipation is that you're going to have the market inertia continue to push it back up towards highs. And it doesn't, right? It comes back down to a new low. Now, the inclination of a newer trader would be to buy another one. and then buy another one, and then buy it, and go in really, really aggressive. For me, I look at this and say, okay, I bought one. The initial pressure off of me mentally is off the table. I'm no longer saying, oh, I gotta find a trade, I gotta find a trade, I gotta get into this trade, this thing's running without me, I gotta get... When you're in that emotional state, you're chasing. You're not playing your technical strategy. You don't want to chase. Chasing never works well. So in this case, I'm looking to buy one. One could mean 1,000 shares, it could mean 10, could mean 10,000, whatever your trading account and trading plan call for. But I'm looking to get in with one, we'll just call them units, right? So I get in with one unit and I'm holding on. Now, do I see a reason why I would want to buy down here? Well, it might be a swing low trap, could be a retest of pre-market structure, sure. Am I going to be buying underneath this swing low and underneath this one and buying a fib pullback and buying? No, I'm not. You know what I am going to do? I'm going to hang on to this one because I haven't had a reason to get scared out of the trade. We have a pull down, sure. But guess what? The stock is up 3.5%. I don't have a reason to be that afraid yet. There's nothing telling me that, hey, sellers are really swarming in. So I'm just going to continue hanging on to this original position. I'm not going to add more because I don't have a reason to. Remember, your average is the most important part of building into a position. If I can get my average down here, I'm going to take that option, right? Rather than taking my average and moving it here. This doesn't do anything for me, right? If I buy one, we buy one here and I buy one here. What does that do for my average price? Well, it moves it right there. Whoopee-doo, right? That doesn't do much for me at all. So if it does start turning down, I have even more that I have to deal with. That's not the situation you want to put yourself in. So instead, utilize this and trade it accordingly, right? This is your area of interest. This is where you bought. Has your trade plan been invalidated? Where was your original risk, right? These are the things that you need to start taking into consideration when the trade doesn't move immediately in your favor. And let's be honest here, rarely does it ever, you buy and it immediately goes in your direction. That's not something very common. So what we're looking for, instead of saying, has this invalidated my trade plan? If yes, then get out. Has it invalidated my trade plan in this case? No, I don't see a reason to really be afraid of this move. We're holding intraday structure from the pre-market. It's still showing that buyers want to continue showing up here and buy this move back up. I just happen to get in a little bit early. So instead, another way to approach this would be to say, okay, well, I still only have the single unit. What I can do now is utilize my actual risk. And my actual risk, regardless of where your original position stop was, your stop may have been down here or here or here or wherever your stop initially would have been, that's irrelevant in this case. What I want to look for is what I had to risk to keep staying in this trade. That's your actual risk. My entry point was here. I had to risk down to this point to stay in this trade. So that means that if the market does start going in my favor and lifting higher, that means then that I want to be looking for an actual risk-reward target of at least 1-to-1. I was willing to let this go this far against me. I better be willing to take that much out of the trade if it goes in my favor, right? So you're looking for an actual risk-reward calculation instead of your initial risk, which could very well have been all the way down here. You don't know. Once we have that calculation, a lot of traders are going to begin following around about that area. They may have gotten in a little bit higher, a little bit lower than you. Doesn't really matter because that becomes a line in the sand. When the market starts going up, watch these actual risk areas because you will find very frequently a lot of profit taking occurs in a zone around that area because everybody's doing the exact same thing, and that would be properly building into a position. In this case, you didn't even have to build into it. You only got the one, and you're managing it accordingly. Now, let's say as an example that this market starts breaking down, right? It gets to a situation where it's holding, it tries to break out, fails, and rolls all the way down. Has that now invalidated my trade plan? If yes, then look to exit, right? So these are the things that you need to keep in mind. If no, then you're looking for your next scalable area of interest, and that could be retesting the open, or it could be the pre-market high retest, or whatever your reasoning for getting in. But getting in way down here does a whole lot for my average, right? That brings my average down a ton compared to what we were talking about earlier with here and here. That doesn't do anything for me. So that's averaging down, and mentally speaking, it's significantly easier to average down. The problem is, a lot of traders do it way too aggressively, way too quickly, and they don't have the account size to back it up. Your exposure on this, right, you need to keep it minimal. You're looking for an account exposure to the markets 1 to 3% of your account. Right? This is the type of strategy. That's the only way that you can trade this reliably without letting your emotions get the best of you, is allocating a really tiny amount of risk. On stocks, you have the nice benefit of being able to buy share sizes. So you can buy 100 shares or something like that. But in one of these situations like this, that's where you've got to be really careful, because if you're doing it too aggressively, all of a sudden it spirals out of control and now you're on kind of the back foot. So you got to play it a little bit safe when you're looking at it in that sense. Now, averaging up, what would that be? Well, averaging up, we can actually just use the exact same chart. We have a nice rally to the upside. It's starting to break away, so I'm going to buy a, looks kind of like a little bit of a pennant here. I'm going to buy the pennant breakout, so I have one. If it goes back up to another new high, I'm going to buy another one. And you just keep adding in to the move, right? You keep going in with the move to the upside, and you're essentially looking to kind of leverage your profitability, right? You're lifting up really nicely to the upside, so you buy one. You buy it on a breakout or whatever your reasoning for getting in, but you're buying above that high. Triggers you in and keeps on going. Pulls back a little bit. We still have a strong trend. No reason to believe anything else, so you buy another one. Now, this does have a negative impact on your average, meaning that your average is going up. You're averaging up into the trade, meaning that it is much easier for the market to come back and be right around your break-even point, and you just gave back all of your profit. So, psychologically speaking, this is a very difficult way to trade. Not a lot of people are very good at averaging into a trade as it's going in your direction. A lot of people are much better equipped to average while it's going down. There are some other factors that we just talked about, like a lack of account size, etc., to be able to do that. But this way is actually probably one of my favorites. I do a lot of scaling in, averaging down into trades that I still have, that technically speaking are still fine. But one of the most profitable strategies is building into a position and averaging up. And that reason being is because when you're averaging into a trade and you get one of those markets that's just absolutely flying, it's really hard to be too upset with it when you have a move like that. So Tesla is a great example. We're out of the gates, we have a deep, deep pullback, and it starts correcting higher, right? And it starts breaking out. Okay, well, obviously buyers are coming in, so I want to buy. We have another little flag pullback here, I'm going to buy. We have another pullback here, I'm going to buy. And you keep buying into the move until you get to your objective. Your objective could be a whole number, like 300 is right here. Could be looking for an objective of a stochastic being, a divergence to the sell side. Whatever your thing is, but you're looking for that upside objective. And when you can bag those trades that just keep going and going and going and going, they'll pay for your week. I mean, heck, they'll pay for your month, depending on how good of a trade it is. So that's the type of environment that you're looking for, is a really strong trend. It's easy to say in hindsight. When you're averaging into a trade, averaging up, you don't know that the trend is really strong yet. You have a good idea that maybe there's a trend move, but it's a lot easier to look back on the chart and say, oh yeah, buy here, buy here, buy here, exit here, of course. That's hindsight trading, right? You have to think realistically here. The real world doesn't work like that. So you have to also imagine, let's look at the sell side here, because Tesla did have a pretty exuberant sell move. Pre-market, you'll have sellers that are selling below here looking for a breakdown. It breaks down beautifully, pauses for a little while, and shows a short-term potential trend resumption, another breakdown. They sell more. This is where you have to be very in tune with how the market moves. When you start seeing signs of over-exhaustion, it's done too much, over-exuberance, right? A parabolic move, if you will. Parabolic meaning that it goes a little bit slow and then speeds up. That parabolic move almost always pulls back on itself, sometimes small, sometimes big, but that's usually where traders are going to start taking some heavy profits. What do we have here? We have a hyper-exuberant move without really any way to add in more. So you have these traders who have been in this for a very long time, and they're sitting up on a huge amount of profit. They're just looking for an excuse to take some off the table. And as it starts coming down, it's holding the 9-period moving average, this faster one here, keeps going down, and it starts turning higher. And we start seeing this bull strength coming in. We're breaking the 9-period moving average. We're running up to the 21-period moving average. If you have, let's say, well, it's Tesla, so it's a little bit more expensive. I was going to say 2,000. Let's say 200 shares, because it's, again, a little more expensive. You take off 150, right? You take off 75% of the position here, because there's a good chance that it pulls back a little bit further. If it gives you a reason to sell more, then you can simply re-enter, but at least you're putting something in the pocket. You're taking that stress off your shoulders. And that's where being very in tune with the markets has a huge advantage when you're building in and averaging up, or in this case, I guess, averaging down. But you're averaging as the trade is going in your favor, rather than averaging the opposite direction. And you can bag some seriously monster winners. And again, the beautiful thing here is that you're taking a partial profit off the table. You're getting that off the shoulders, right? You're taking that stress away so you can manage it properly. Again, it's all about the mental game. And when it comes up, if it gives you another reason to add in more, then so be it. Add in more. And if it gives you a reason to get the heck out of the trade, then get the heck out and take the last off the table. But that's going over kind of the idea behind scaling in and averaging in or averaging down. And again, the psychological battle that you have to fight with yourself in the sense of not doing it too aggressively, but doing it just enough so you can leverage the move overall in your favor. It's a very delicate balancing act, and it is very difficult to do correctly. But if done correctly, and practice enough, whether you're doing it on a sim account or really tiny size on a Robinhood account, whatever. But practicing makes perfect in this case, and really understanding the way that the markets move and getting a feel for how they move, of course, along with that being part of just the way that you like trading. You have to like doing it, of course. It's a huge, huge benefit. So really, really awesome to look into. Something to potentially add to your tool belt if you're looking for ways to leverage the trade. Hopefully you learned something. Hopefully you found it interesting. Underneath the video, make sure to click on subscribe. Click the notification bell icon so you don't miss anything from us again. That way you don't miss anything important. We release videos very frequently, so you don't want to miss any of those. Aside from that, if you have any questions about it, feel free to shoot me an email. jbrink@slingshotfutures.com. Can help you out from there. Aside from that, hopefully you learned something. Hopefully you can add something to your tool belt. And until the next one, we'll see you all then.